Okay, guys, welcome to our 2024 real estate market forecast. We are back with Brett Reichel with Community Wholesale Lending. How many years have we done this now, Brett?
I think it's been 4 or 5, maybe 6 years.
4 or 5 or 6.
Yeah.
Okay, we probably need to set the stage here a little bit because you may notice our studio looks a little bit differently. So first of all, I want to thank Adam Schwartz, realtor in Riverside. We are using his studio today. Had a little conflict with our Canyon Lake studio, so we got a little new background. What's good in Riverside? So thank you to Adam and his team for helping us out. So Brett, so here we are 5 or 6 years from now, or since we've done our first interview for the forecast. We're doing it again. So we did a little bit of a debrief on kind of what we do, but as we've done in the past, we never sit down and compare notes on what we're going to talk about. So I think we said, maybe we just kind of talk a little bit more about the industry, and maybe we dabble on interest rates and what the Fed's doing, and we can put our forecasts and our future. We briefly spoke at the sales meeting yesterday about MBA's forecast for rates, so we'll jump into that. But I want to talk a little bit about industry.
Okay.
So part of our market forecast deal has not just been the market forecast.
Sure.
We brought in probably 5 or 6 years ago. You might have been one of the very first industry leaders that I said, hey, we're not just going to bring in Chris Thornburg and do the economic thing. Let's bring in the real estate industry folks, the lending industry folks, and let's talk about that. So that's you. So how long have you been doing this? What's going on with community wholesale? What's the industry doing? Let's just start with that. So
I don't want to say how long I've been doing this. It's a long time. So I've either sold real estate, or I've appraised real estate, or I've financed real estate, or managed people in those industries, since I got out of high school, pretty much. So it's been a long, long time. And I've over 30 years in the mortgage side of it. So it's it's been a great career, and it continues to be a great career, and I enjoy it, and I'm going to continue to do it. So, and as far as community wholesale goes, it's a new chapter in my career in that I have branched off from being a non-producing manager who produces a little bit to being an account executive that calls on mortgage brokers. Okay. So my primary responsibility at community wholesale lending is to call on mortgage brokers and encourage them to send business to community wholesale.
Okay, so you're not necessarily, today anyway, working directly with the agent public.
Yeah, in fact, on my transactions with community wholesale, I don't work with the agent. It's not my place. My place is to work with the mortgage broker.
Got it. So, on the wholesale side.
Correct.
Hence the community wholesale lending.
I'm far more business to business. A regular loan officer is business to business and business to consumer. So business to business in that they're talking to the realtor in the transaction, but really build business to consumer because they're making loans to people. Right. So, and I don't really interact with the consumer at my role at community wholesale.
Yeah. Well, one of the reasons I think you and I have connected over the years is we pretty much have the same career path. Mm-hmm. I mean, we're very close in age. We both got into this business very young. Was 19, 20 years old.
Yep.
Basically the same thing with you. And again, for all of the challenges that I've had in my career over the last 35 years, I love what I do. Mm-hmm. I can't see myself ever doing anything else. But it's been a challenge. There's certainly times that have been a challenge. So I want to set the stage and talk a little bit about the real estate industry. And if you guys have followed any of my stuff on the market forecast before, I've been very candid that and again, I'd be very careful when I say this because we have a lot of different people in our audience. We have buyers and sellers and landlords and tenants and realtors and all of the above. So when I say the real estate business is broken, if you're a seller or a buyer or anybody in that world, I need to be careful because I'm talking about not the market. The market, I mean, prices, looks like we're going to maybe see some stability in pricing. Maybe we can talk about that a little bit later. We've got some inventory challenge and all the rest of it, but the business of owning and operating a real estate office has been challenging for a decade, maybe almost 2 decades.
Yeah.
And I've used the term broken a lot. And when Mark Dowling with Inland Valleys Association of Realtors, I've done a lot of panels with him, and he doesn't do it so much anymore. But whenever I would say the business is broken, he kind of just gets that kind of that uncomfortable feeling. What is Lance going to say? I'm like,
exactly.
It's just by the way, also if you're a real estate agent, I'm not talking about the agent. I'm talking about the owner operator of running a brokerage, just because of the dynamics. So is the mortgage brokerage business as the owner operator of a mortgage company or mortgage lender, is it broken in the same way the real estate industry is, or are you guys just fine? How's it going over there?
Well, I don't think it's broken. The business itself is broken, like real estate is. I think it has its challenges. I mean, the mortgage business is much more highly regulated than real estate sales.
Yep.
So we have, so a company of any size that's licensed in many places has a lot of people coming in every month or every other month auditing their books. So we're licensed in like 15 states. So we're going to have audits from 15 states. We're going to have audits from some of our investors. We're going to have audits from Fannie Mae. We're going to have HUD audits. We're going to have audits all the time. State of California is going to come in. So, they look at a lot of things. Now, with that being said, I'm not so sure that all the auditors understand the laws or the rules, because it seems to me that a lot of rules aren't being followed, but that's a whole nother conversation.
Right.
And I probably really don't want to go into it much because I don't want to alienate my customer base.
Right.
So, but I think that I wouldn't contest or say it's broken, but I will say that the mortgage business over the last year and a half, 2 years, is in a Great Depression.
Okay.
So I got in the business in 1979.
And is that because of transaction volume, or am I being too simplistic?
No, you're being right on. It's
Okay.
transaction volume, and it's we were over capacity, and we're probably still over capacity, and we've seen a great shrinking of the number of originators, a great shrinking of the number of support staff that supports originators, processors, closers, underwriters, that stuff. So it's quite frankly the most challenging market I've seen since '81. And I wasn't in the mortgage business in '81. I was a realtor who worked way out in the suburbs and or the exurbs and developing area. And we worked in what was at the time a big real estate office, and I saw 5 mortgage guys a month maybe.
Right.
3 of them were mortgage bankers, and 2 of them were savings and loan guys.
Okay.
So that was probably the nadir of the business, and we've been there recently. It's been a very, very challenging time for a lot of originators. Now, there's some originators, just like all times, just like in real estate.
Right.
There's realtors that are thriving and setting records. There's originators doing the same thing, but it's tough for your average loan officer right now.
But so those originators, loan officers, I made that 95-5 rule that I've talked about 1,000 times. I won't reset it here, but 5% of the agents are doing 95% of the business. Is that a similar deal with the loan originators, that you just got this top tier that are just killers that have the relationships and been doing it?
Yeah, probably. So when I call on mortgage brokers, there's mortgage brokers out there doing over 100 transactions a year.
Okay.
I categorize for me to focus on if you're doing above 1 a month, you are an A client. Now, that would never have happened before.
Right.
If you're doing between 6 and 12 a month, or 6 and 11, you're a B client. If you're doing below 6, you're a C client. If you're not doing that, you're a D client. So the A clients I call, the B clients I call sometimes, and the C clients I let them call me.
Right.
And those numbers are significantly lower than what they would have been in the past. It would have probably been 6 deals a month and something like that. I don't know what to tell you. 3 deals a month and 1 deal a month.
But now we just got the volume.
The volume's just not there. The volume's just not there.
Well, I want to go back a second, but I don't want to get off of this topic. I want to kind of go back and redefine my definition of broken. Okay. And again, I'm not in the mortgage business, so I'll show my ignorance on I want to learn. So it wasn't that long ago, maybe this isn't the case anymore, but I would see an article on Inman or on, from mortgage bankers basically saying that the industry is losing money on every single loan that's being generated, or the amount of profit being made was like ridiculously small, to the point where it's like, wow, nobody's making any money on that. Is that still the case? Because that sounds broken to me. If I'm Walmart and I'm making it up in volume, but I'm still losing X amount of dollars per loan that's being originated, that seems problematic to me. So and I assume that was not just a transaction volume. I just assumed that was just a pure competition thing. So the volume was so low, it's like, okay, well, you guys are just competing against each other on pricing and fee to the point where you're literally losing money. First of all, was that accurate?
Yes.
That was. Is that still going on?
Yeah. The last 24 months, I don't think the MBA averages, I'd have to look, but I don't think the MBA averages would reflect that your average mortgage company is profitable, and that its per loan losses are quite great. I think 64% of businesses lose money on loans, and businesses are merging. things like that. People who've been in the business 20, 30 years are now no longer in the business. They've gotten merged into someone who's been in the business 10 or 15 years. But the secret is, I didn't say broken earlier because I guess you could call that particular aspect of it broken.
Right.
It's evolving. It's certainly different than it was when I got in the business, and any time since I've been in the business. The mortgage, the reason I went to wholesale is because it was super slow at an independent mortgage banker. It was super, super slow,
right.
And knocking on doors of realtors and asking for setting up referral partners. And, I had a great deal of success with that. They didn't have any business to send me. Right. So, and I enjoy the aspect of what I do, which is solve problems, structure transactions, which I'd done as a manager of a large branch for many, many years. And so I kind of do that where I'm at. But with the losses of the independent mortgage bankers, I mean, the losses are tremendous. You can see it in their stocks.
Yep.
The company I'd worked for previously, they lost, hundreds of millions of dollars. Some of that is in how they report things on their books. Some of the companies that are larger than that company that are reporting profits are reporting, things that company didn't report because bookkeeping philosophies, accounting philosophies. So they're certainly still a good company. Don't get me wrong, but that means cutbacks in a lot of things. And the issue that those independent mortgage bankers have more than anything else is they're losing money. It's very expensive to manufacture a loan. In the mortgage business, we call it manufacturing a loan.
Okay.
So that means you make application with me, I put it in the system. Well, I've got to pay for the system. Number one, I got to pay for the processor, my loan assistant, the closer, compliance.
Compliance. Did I say compliance?
Yeah, that's kind of a big deal.
Yeah.
So I think that's north of $12,000 a loan now.
Wow.
That's a lot of money.
Just the support.
Just to manufacture the loan. That includes the loan officer's comp, which is a significant portion of everything. Right. But that's on average.
Right.
And the average I think if 64% are losing money, that's a big deal. And that's why we're seeing so we've seen a couple of things happen. We've seen the banks back off of mortgages. Okay, so the banks have backed off mortgages because they're worried about liquidity issues.
Okay, like Wells Fargo, for example.
Correct.
Has exited the residential. Is that still the case?
They haven't exited. They just cut way back.
Okay.
Chase cut way back.
Right.
All the big banks have cut way back. I mean, in the Obama administration, they used some arcane rule from like 1875 to find the big banks because the big banks had the money for their FHA underwriting, even though FHA, was authorizing all this stuff. And I don't feel that was fair. And so as a result, for example, Chase, the guy that runs it, said, I don't ever want to do another FHA loan. Ever.
Right.
He said that in the New York Times, the Washington Post. I read it locally. So it's like, oh, wow, that's interesting. So, and they've backed off that. Well, we're worried about Basel III a few months ago, which is a new requirements for banks to have money in reserve, et cetera, and the valuation of mortgage servicing rights and all these different things. So the banks are saying, well, that's going to be tough on us. We don't want to be focused completely on the mortgage business because it's a low margin business. Okay?
Right.
When you make money, you make a lot of money, but it's because you're doing a lot of loans.
But it's a low margin business that's for the last 2 years has been losing
money like crazy.
Yeah, so it's not a low margin; it's a no margin business
for a lot of
at
people.
least, or negative margin business for at least for the time being.
There's a rumor of a local mortgage company in the Southern California area losing $50 million a month.
Yeah.
That's a lot of money. It's not the company I was working for.
Yeah.
So.
Well, but again, that's a lot of money.
Yeah.
And that's why, again, getting back to be a little selfish here on the brokerage side, I'm independently owned and operated.
Right.
I can't lose $50 million a month. I can't lose $50,000.
Come on. You could probably dig that out of your
couch,
right?
I could do it for a few months. And then after that, then maybe we got a challenge. But it is an interesting the way our industry has evolved. Mm-hmm. And again, the volume part just makes it that much more painful. My margins are small. I truly have small margins.
Without a doubt.
And we need to have a certain transaction volume to make that work. And then when the transaction volume is below that, it does not work. And yes, we've been losing money at the real estate operation, which is why, again, I don't want to go down this path, but real estate companies don't just do real estate. We're doing escrow and mortgage partnerships, which we don't have, but we certainly have an escrow relationship. We have property management. We have some title relationships because you have to. So on the mortgage side, in a low margin business, which now for, I guess, 24 months sounds right, the volume is kind of cratered.
Yeah.
So how much longer can that unnamed company lose $50 million a month before that plug gets pulled completely, either by them or somebody else?
Well, it depends on a couple of things. Depends on how quickly they recognize the handwriting on the wall, or how much money they have, or a whole bunch of things. So that's a question that I would imagine a lot of independent mortgage bankers are asking themselves. So what happened is the bank started to pull out of the business in the mid 2010s. The independent mortgage bankers created a huge portion of that business. They grabbed a huge part of market share. There was a lot of money. They made a lot of money in 2021. The average margin was probably 200-300 basis points alone. They were making money like you wouldn't believe. That's why they own basketball teams. That's why they fish around the world for 1,000-pound fish with yachts. So you can follow these guys on Instagram if you want to, and they made a ton of money, and they're enjoying it. More power to them. I don't hold that against them. That's what we're all aspiring to do, right? But so that part of the business grew. But here's the issue: is when margins started to shrink. Margins started to shrink in 2018-19, the last quarter of 2018, the first quarter of 2019.
Yep.
And then we muddled through 2019, and the mortgage business was lucky enough to have a pandemic. And when I say
isn't that
lucky,
crazy? Yeah, I know what you're saying.
Interest rates collapsed, and we made money like crazy. And the margins were fat.
Right.
But when that stopped, what's that old game you used to play in the middle school carnival where you went around and the last seat?
Duck, duck, goose, or one of those. You pull the chair out.
Yeah, pull the chair out. Yeah, so that's kind of what we're in now. And so we're seeing, at an independent mortgage banker, where the big issue is you've got, at the giant companies, you've got shareholders. So there's a dozen that are public that have shareholders.
Right.
And then at the other companies, you have a CEO, you have a president, you have a CFO, you have all the C-suite guys. You got a national sales manager, you've got a regional sales manager, a regional manager, a district manager, you've got a branch manager.
Got a lot of overhead.
That costs a lot of money, man.
Yeah.
That costs a lot of money. I've seen interest rates vary by a full point in interest rate on some files, comparing an independent mortgage banker to a broker. So what we've seen as a result of that is people recognize that, and the mortgage brokerage side has grown from probably 7 or 8% of the market in 2010 to, I think right now, depending on who you talk to, it's between 24 and 25% of the originations.
They're filling that gap.
They're filling that gap.
And that's just, they're smaller, they're more nimble. I mean, is that?
It's like your company. So your company, you are the CEO, the COO, the CFO, right?
Yep.
You've got a bookkeeper that helps you. You run in QuickBooks, and that's what these brokers are doing.
Right.
And they don't have those layers of overhead.
Right.
I talked to a guy who worked with me. I mentored him in the business, and then he mentored me into running big branches as he grew in his career. But he was a national sales manager for a major national mortgage company. And he was let go with COVID because they don't need a national sales manager to travel and rah-rah the troops.
Right.
And he decided to semi-retire and be a mortgage broker. And he's like, oh, my goodness, this is the best thing that's ever happened. And
Right.
they don't have to pay for me anymore. So I get so much a better deal. And I think that's one of the reasons the mortgage brokerage side has grown so fast.
Yeah. Well, it's funny, and I may get this wrong, but it seems to me over my 30 years, I'd have different relationship with different lenders, and periodically something would go wrong, and then I'd hear complaints. Oh, that's the broker. Oh, it's the mortgage broker. You should have gone with a mortgage banker, or you should have gone with one of the big boys or whatever. And I'm like, maybe there was some truth to that at the time, or maybe the broker wasn't efficient or whatever it happened to be. But it almost sounds like, not almost, what you're describing is you're in a much better position today if you're that smaller, nimbler mortgage broker than if you're one of these big guys that's just tough to steer the ship, or you can't lay off people fast enough. I don't even know. It just,
well, you don't have, if you're a mortgage broker, you probably don't even have a processor. You probably have a contract processor.
Right.
So you might have a processor. There's a person in town here that runs a very successful mortgage brokerage, does a lot of loans. She's fairly well known. She does a lot of great marketing. She runs a great ship, and I would put her up against any mortgage banker. She's doing a great job. And
she knows what she's doing.
I barely know her, but
Right.
I know of her, and I admire her from a distance. For her business acumen, she's really sharp, and so it's all in who you deal with.
Yeah.
It's just like your realtors,
Same
right?
thing.
You've got.
Same thing.
I mean, a good realtor, it's worth their weight in gold.
You think?
I've been doing this forever, and I really like and respect a good realtor.
Yep.
But yeah, poor realtor, oh my goodness.
Well, it's the same.
The same thing as mortgage bankers. So it's a mortgage lenders. It's the exact same thing. So if you deal with a great loan officer or a good loan officer, they're worth their weight in gold.
Right.
But if you deal with the crummy ones,
Yeah. It's interesting. We're going to finish our interview. We got time, but Art Carter from CRMLS is going to come in right after you. We're going to sit in front of Adam's logo here, and we're going to do it again. All sorts of turmoil and change coming on in the real estate brokerage business. But the great agents are going to do just fine and probably end up excelling and actually doing better because they have value and the consumer will see that value and they're willing, in theory, going to be willing to pay for that value. So same thing with the loan officers.
Well, you and I both know that in a time like this where there's lots of turmoil, is a time where someone's going to rise out of the ashes of the business and really make a difference. It's really a time to set the place for yourself. One of the reasons I went to community wholesale is the guy that owns it's really brilliant. He's really sharp. I admire him. I've admired him for years. And I think I don't know what a good metaphor is, but it's like, it's going to go somewhere.
Well,
and I'm going to go with him somewhere.
Right.
And I'm going to be more successful because I've attached myself to another successful individual who I get along with, share a vision with, and I can contribute, and he can contribute, and our team can just grow. And that's kind of what I'm doing.
That's the exact conversation we just had. You see value in his company through him.
Yes.
And I frankly see value in you. Otherwise, you wouldn't be sitting here.
Well, thank you.
And, again, my 95.5, or maybe that's not even fair. Maybe it's a 99.1, right? I mean, especially at that level. So where are you guys at Community Wholesale going? What's the long-term plan? Mergers, acquisitions? Are you just going to just refine what you're doing, or just where do you see your role within that company over the next 24 months?
My role in the next 24 months is to develop accounts for the company and grow my production and the volume of the company. Right. My production portion of the company's volume. I see myself growing in that position over time to perhaps becoming a sales manager for that company and having a team of account executives.
Right.
And growing on that job based on my learning and expertise and experience.
But you're not dealing with realtors anymore.
Nope.
Yep.
Nope.
Which I saw you at my sales meeting yesterday, and I'm like, okay.
Why is he here?
Yeah, well, I know why you're there, because again, you've got 30 years of relationships,
right?
And that's going to turn into whatever the next relationship is, even though your current role is different.
Right.
Interesting. Okay, well, let's do this. Let's segue here a little bit. We kind of talked about our industry. Yesterday, we briefly talked about. I put you on the spot and about what the MBA, Mortgage Bankers Association, is thinking. So I want to bring this back to transaction volume, because so much of what we do is dependent upon us being able to do enough business to keep the doors open and keep those margins correct. So you did, I don't want to put words in your mouth because I don't remember exactly, but what does Brett think, or the mortgage bankers, assuming you agree with them, where are we going to be from an interest rate perspective at the end of this year?
So I don't know what the mortgage bankers say. I think that when I talked yesterday, I popped off at 6.5, but that's what Wells Fargo said yesterday. That's what I had 3 people in my newsletter I sent out on Tuesday. I don't remember exactly who the 3 were, but there were 3 major organizations that predict this kind of thing. I think one was Fannie Mae. They said 6.4.
Yep.
One was Wells Fargo. They said 6.5, and somebody else said 6 point something, and they all had said 6 before. So they'd all basically increased by about 0.5%.
Right.
So I wouldn't be surprised to see that. I don't see. I really believe that I need to, you need to, he needs to, everybody out there, you all need to forget about interest rates.
Yep.
You can't. Your customer's always going to remind you, but interest rates are what they are.
Yep.
And they're high.
Yeah.
They're not as high as they were in the 80s, but house prices are a lot worse than they were in the 80s. So it's like they're high. I read a stat. I saw a stat this morning on I was watching a video on the market, and it showed the average debt to income ratio. It's 40% right now.
Yeah.
Highest ever.
Yeah.
Highest ever. 39.1 prior to the 2007-8 collapse.
Okay.
So I don't see that collapse happening. But I think rates, 6.5 are reasonable, and they're 7-ish now. So.
Well, I've been obsessed with them, but about 6 months ago.
We have to be. That's what we do, right?
Well, it is, because we tie it to transaction volume.
Right.
And when you see interest rates improve a little bit, or we get some favorable numbers, which is so crazy, depending upon how you want to describe favorable. A CPI comes out, and this comes out, and it's like, wow, that's a great number. Well, that great number means the economy's hot. Well, that means that the Fed's going to try to slow things down, which, you know, means all of these talks. By the way, we got to date stamp this. Probably should have done this in the beginning. So today is May 23rd, 22nd, 2024. The average, you know, index of 30-year mortgage rates today are a little above 7-ish. Okay. But sometime in the last 30 to 40 days, they were knocking on 8, right?
Yes.
And then maybe 30 to 40 days before that, we were, you know, 6.5. So, which might not seem like that big of a swing, but on a
$600,000 loan, dude. Yeah.
Well, yeah. Well, I'm not even talking about the loan. I'm just saying within a matter of 60 days to basically have a 2-point spread up or down from 7. That's a big deal. Yeah. So my obsession with Chairman Powell and the Fed hasn't really been so much the rate. It's been what's the consumer perception of that, and you can see it. You can. I'm assuming you'll agree with this. When we start to see rate improvements, or at least when we start to see the talking heads talk about rates improving, the consumers hear that and it's like, hey, honey, let's go out, and maybe they're actually paying attention, and we see volume increase, transaction volume, and then a couple, you know, inflation reports come out or a CPI comes out, and then, oh, wait, we're not going to get 7 or 6 Fed cuts, which is so hilarious because we're, you know, we talk about the cuts like it's the end-all be-all of everything, and there's so many other things associated with it. But you can track it. You can track the volume and the consumer sentiment, if you will, to where those rates are. So my thing has just been, if it's 6.5, if it's 7, if it's 7.5, give us a couple years of some stability. Now, if that stability slowly means we trend in a more favorable direction, okay, fine, so be it. But it just, the volatility has just been nuts.
Yep.
So you're seeing the same stuff I'm seeing. If I go to CAR or MBA or Barry Habib or whoever it happens to be, everyone who was saying we're going to be sub 6 is pretty much, you know, canned that, and now low 6, mid 6s. But you know, just stability. Wouldn't that be nice? Just for a minute.
Yes. For
a year or two.
Yeah.
So from a volume perspective, what does that mean? Let's just say a baseline, we're at a 0. So are we going to see more transactions on the trending positive for the rest of the year, or maybe 2 flat?
Well, if rates improve, I mean that the reason we track rates is if they improve, the market increases, because it's very simple. More people can afford a house. Right. You know, they're at 40% debt to income ratio. Those people are maxed, and if they go down to 35, then all of a sudden they're more comfortable.
Can they? And not that this is a trick question, but I truly believe this is the case. And you a minute or two ago had said, hey, you know, debt to income ratio is at 40%. It hasn't been that high since 2007, 2008. You know, I immediately have, you know, you trigger me. I go back to the, you know, Great Recession and the collapse of real estate. And then you immediately said, well, but I don't see that. Nobody sees that.
I can tell you why. So
well, I'm going to give you a chance to tell me why. But with that being said, we start to see rates improve. Buying power of the consumer now goes up. They come back into the market.
Yep.
But we also have an inventory problem.
Correct.
Of available homes. Aren't we going to trade one for the other? A
Yes.
lower interest rate for a higher price? And then at the end of the day, it almost kind of seems like we're on this hamster wheel.
That's why we need, this is probably off topic, but we need relief from regulations that limit and inhibit development. I think the federal government, I think the state government, and I think the local governments have done our population a great disservice by inhibiting development. And I know they're all going based on who votes for them. They don't want anything in their backyard. But the bottom line is the reason I don't see house prices collapsing like they did in 07, 08 is in 06, Gen X was at the perfect housing creation age, which is the smallest generation we've had since the greatest generation. Okay. So the baby boom was huge, Gen X was small, and the millennials are huge, and Gen Z is huge. So we have 2 generations, demographic generations that we talk about all the time that are as big or bigger than the baby boom, and they need your kids and my kids are millennials.
Yep.
and they're having children.
Yep.
And they need to form households.
Yep.
And they need to have
And
a place
they're
to live.
doing it.
They are, and they're going to
Right.
do it whether we want them to or not.
Yep.
And here's the funny thing: is they're going to buy a house.
They are.
Unfortunately, it's only going to be the ones that make really good money.
Right.
Because the other people can't afford it. When I moved to the Inland Empire in 2012, people are like, "Oh my goodness, house prices are too high," and I'm like, "What are you crazy? What does it take to qualify?" So I can get two people who work as cashiers at Costco, and I can, if they're married, they can buy a house.
Right.
And they can buy it in almost any neighborhood in the IE. Maybe
Right.
not Rancho, maybe not Chino Hills, but almost any neighborhood. And that's not true anymore.
Right.
That's not true anymore. You have to make about $120,000 you can buy a house.
Well, and in the Inland Empire job market doesn't necessarily support that.
Correct.
Yeah.
Yeah.
But you compare prices, median price in more in Riverside right now, so probably $575.
Yeah, and I'm a little
600,000.
skewed because I'm centered in Rancho Cucamonga and have been, so it's a little higher price.
It's higher, but yeah, but
but I
even
mean,
with-
I've
but-
worked all the Inland Empire.
Yeah,
so, yeah.
but the statement is still just as true.
Mm-hmm.
But then you've got again, and by the way, it's not off topic to talk about the regulatory environment that's preventing building and construction
Well-
and all the overlays and the fees and the entitlements. It's frankly what we've been talking about at this forecast for. Forget about the forecast for 20 years.
Well, the cost of getting a permit in a city, it's got to be 45 or 50 grand, but that doesn't add up to everything else. You have to add the mass transportation fee, the this, the that. You're looking at over $100,000.
Yeah, depending upon the community, the number that I hear, all the time is over $100,000 of just pure entitlement fees before we put a stick of wood into the ground or pour a slab.
Right.
And that's a problem. The challenge, of course, is, again, we've talked about this. You and I have talked about this. Chris Thornburg has talked about it. Everybody, John Husing has talked about it. Manfred Kyle, all of the economists, and Joel Singer at CAR, my God, 25 years ago, we're not building enough housing in California. There appears to be no solution to that.
Well, it's going to be interesting.
But just real quick though, the solution, there is a solution: rental housing. And now we've got rental housing also at all-time highs. You can't rent a 2-bedroom apartment in the city of Riverside that's $2,500 now. 2-bedroom apartment.
Yeah. Yeah.
That used to be Orange County numbers.
Well, and that far outstrips inflation. We all talk about inflation and how tough inflation is.
Yep.
But the one of the reasons inflation on the numbers, like the 3.5 CPI type thing, is big is because of house prices, mortgage interest rates, and rents.
Right.
That's one of the major components that's resistant to these higher interest rates because of that demographic glut of people who need to have a place to live.
Right.
And our elected officials failed us by not seeing that coming.
Yeah,
And they may have seen it coming, but they failed us by not seeing it coming.
Yeah, I think they saw it coming, but for whatever reason, there wasn't the will or the desire or the political.
I think it's because what gets votes now is not looking out for the population, but whatever gets you most excited and makes you respond on social media.
Yeah.
But it's unfortunate because that's a huge problem that we have.
Yep.
And I don't really know what the answer is. I've thought maybe that, and I don't know if anybody's doing this, but you could create a land trust where you lease the land for 50 years or something. There's all of these things to help buyers afford more house. The home buyer assistance programs. But my issue with home buyer assistance programs, I mean, I love them, it makes me more money. But for the market's health, is it creates more demand.
Yeah.
We don't need more demand.
We need more housing.
We need more housing.
Right.
We have a lot of programs with zero down.
Yep.
We need more housing.
It's a good news, bad news thing. The good news is if you own real estate today, or if you have the ability to afford real estate today, in theory, it's a safe investment. Getting back, the market's going to crash, all the rest of that. Well, it's pretty hard for the market to crash with the supply as low as it is. So if you can afford, or when you go back and look at these forecasts, the pre-COVID one is the one that sticks out the most to me. Coming into January of 2020, we've been coming off a few decent years of appreciation. And then, the world's going to crash, And then COVID hits in March of 2020. And then all of those people, and by the way, I might have even been one of them for a minute. I'm like, oh my God, never experienced this before. What's this going to do to the real estate world? And then, of course, now we got people working at home and more flexibility. Now they don't have to work as close. And the real estate market blows up in a positive way. Demand goes through the roof. Supply certainly didn't keep up. 20% appreciation in 2020 and 2021. You guys are making all sorts of money on the lending side. So again, if you own real estate and you can afford to buy real estate, you're great. The flip side is there a certain amount of population that's just going to be locked into renting for an exceptionally long period of time? And,
Well,
I mean, we're a majority renter state in California right now. Majority
absolutely.
renter.
Yeah, and I think the thing that if we have consumers out there, watching, the number one thing you have to do is isn't great for the economy, but it's great for your economy, is limit your consumer debt. I mean, consumer debt is a killer for getting a mortgage loan.
Right, and that's been blowing up in the last
and it's
2
been
years,
that way
3 years?
my entire career.
Yep.
It's gotten worse in my entire career. Down payment's an issue, but in this world, down payment, we can get you in with a little down payment, but that consumer debt is a killer, because that's where that debt to income ratio comes from. So
and again, when we do have, we have a very diverse audience, but a large percent, we do property management. You know that. A big chunk of what we do is property management. I'd like to think a good percentage of our audience are the tenants that are renting those properties.
It would be smart if they would,
Well, they should, and we market to them.
Right.
And we want those tenants to buy houses.
Right.
So listen to Brett, that consumer debt. The car loans and the credit card loans and the whatever loans. Right. We're just going out and charging on the Visa every time we go to McDonald's, and financing I was going to say a $10 hamburger, a $20 hamburger now. Right? I mean, it's a kiss of death.
And people are concerned about 7% interest rates while they're paying 20 on their credit card.
20? I mean, God,
28.
Yeah.
So it's like, so it's, 28% on your credit card. I mean, if you have a really good credit card rate, you got 18.
Yeah.
And everybody says, mine's 0. Okay, bring me the statement and I'll put it in the file.
It was 0 for 3 months.
And it was 0 when you got the darn thing, but it's 28 now.
I have some of those, actually.
And you can look at the statement, and it's got this thing on it that says if you make the minimum payment, you'll have your credit card paid off in 30 years.
It's a mortgage.
Literally.
For that hamburger.
30 years.
It's crazy.
And you'll have paid this much money. What if you want to pay off in 3 years? Pay this much money.
Yeah.
So please pay off into the 3-year time frame. Yeah, it'll be way better for you financially.
Yeah, interesting times. Okay, so
now I sound like an old guy, don't I?
Well, no, but this is where we're doing.
I've been preaching this my entire career.
Yeah, so, but how many, thousands of homeowners have you helped? Over the last 30 years, acquire homes. We've done the same thing. Yeah. I mean, it's one of those. It's funny. It's one of those things where for a decade, certainly over the last 5 or 6 years, when interest rates were ridiculously low, and not to segue into a different conversation, but we got rates at 3% and sub 3%.
Right.
And I'm literally screaming at everybody I can, you've got to buy a house.
Yes.
Even if you think that, but the market's peaked and we're going to see a pullback in values, doesn't matter. Go buy a house. You're never going to find money less expensive than 3% or 3.5%. And
great advice.
I have friends and family and clients that I've done business with for 25 years that didn't listen to me, and they had the ability to actually buy, and then they didn't.
I've talked to some of them.
Yeah, you certainly have.
Yeah.
And some of them, guess what, have recently purchased at a price that's 40-50% higher than they could have in 2000, and at a mortgage rate that's was at 7. When they could have got it at 3.
And for everybody out there who thinks interest rates are going to be 3 again or 2.5 again, there's a couple things that happened that brought those rates down. Number one is obviously the Fed lowered interest rates, but what nobody really realizes, maybe us in the business do, but the public may not realize, is the Fed spent trillions and trillions of dollars buying treasuries and mortgage-backed securities, and that changed the market. When you buy a mortgage-backed security and there's a big buyer like that, that affects the interest rates, makes the interest rates go way down, and we learned a valuable lesson as participants in an economy that that is a great thing to do, but we did it too long,
right?
and that's why we got stuck with inflation.
Yeah, rates were too low for too long.
Too long. I don't believe that people that run the economy will make that mistake again. They're going to learn from what happened this time.
I'd like to think
they'll make a different mistake. They're going to make a different mistake.
Yeah, I don't know. I've become disillusioned with the leadership in our country. Thinking, I've always thought, and I've talked about this in my market snapshot for that last year. I've been one of those people that's like, and I still do. Don't misunderstand me. Mad respect for people who put themselves in that position, make the decision, and I've said, wow, we've got some brilliant, smart people that are running the Fed or running, local, state, federal. politics. And God, I want to believe that that's true. But man, it just sometimes I'm like, it just doesn't feel that way to me. But anyway,
it'll be interesting to see what history reflects down the road, with lots of time to think about it, lots of time to see the ramifications of what happened surrounding the pandemic, or what was perceived as a pandemic. You know, whether we pulled the trigger on things too soon, too slow, whatever the case may be. And you have to remember, economies like we have are heavily run on psychology.
Yeah.
And the perception of the public.
The perception.
So,
That's right. And, and Rick Hoffman 2 years ago, as we were in the pandemic and we were coming, I need to get Rick back. And he was talking about, so what do you think is going to happen when we do this? And what do you think? And he had this great line. I'm quoting it 3 years later. He says, I don't know. We've never done this before. We've never come out of a pandemic.
Yes.
We've never gone through this and through that. I'm going to be talking to Barry Lee O'Connor about evictions later. We've never come as a landlord-tenant relationship through eviction moratoriums that lasted almost 3 years, and now we are.
Yeah.
And what does that look like? What does the mortgage rates look like?
And not only that, you have your squatter problems.
And then we got that.
Yeah.
We got that.
Which we've never had before. So.
Which we haven't. So what a great way to end our interview on squatter problems. So at any rate, Brett, my friend, I appreciate you again.
Yeah.
This video is going to post before our event, which is May 29th. That's next Wednesday. We're shooting about a week in advance. May 29th at Cal Baptist University. Again, I want to thank Brett Reichel for coming in again.
Yes.
And we'll hopefully see all of you, or most of you, on May 29th at Cal Baptist College. Registration is at 8 to 9. We'll start at 9. We'll have a bunch of great speakers. Click the link below, get all the information, and thanks for watching.